You know, there's this game hidden inside our entire financial world. It's not played on a board. Nope. It's played in these tiny, almost invisible gaps. Gaps between markets, between moments in time, and between what a handful of people know and what everyone else thinks they know. Today, we're going to pull back the curtain on that secret game, arbitrage. So let me ask you this. What if you could actually profit from a glitch in reality? I mean, a fleeting moment where the very same thing, a stock, a currency, a barrel of oil, has two different prices at the exact same time. That contradiction, that little mistake in the matrix, well, that's the core of everything we're about to dive into. And that glitch, it has a name, price discrepancy. It's this simple but incredibly powerful idea that an asset can be worth, say, $1 in New York and $1.01 in London at the very same instant. Now, this isn't some mistake in the system. For the people who know what they're doing, it's a wide-open invitation. And the art of jumping on that tiny, fleeting opportunity is arbitrage. Okay, so how do these opportunities even show up in the first place? Well, the first battleground, the first layer of the game, is what we can call the information game. And in this arena, let me tell you, knowledge isn't just power, it's straight up profit. This right here, this basically shows you the entire playing field. On one side, you've got asymmetric information. That's a critical detail that only one person or group knows. And on the other side, symmetric information. That's what the whole market knows, what's already baked into the price. The entire job of an arbitrageur is to live in that gap, to find that private knowledge and turn it into cash before the rest of the world catches on, and that window of opportunity just slams shut. And believe me, these information gaps are literally everywhere, from the really simple to the insanely complex. Geographic arbitrage. That's the classic textbook case. Buy a stock for cheap on one exchange and instantly sell it for a bit more on another. But it gets way, way more sophisticated. Think about merger arbitrage. That's basically placing a huge, high-stakes bet on whether a corporate buyout is going to go through, all based on deep analysis or maybe some insider info. Or what about jurisdictional arbitrage? That's where a company might use different tax laws in two countries to literally create a financial advantage out of thin air. But look, information is only half the battle. Because even if you have the perfect piece of intel, it's totally worthless if you're too slow to act on it. The other, and maybe even more intense arena, is the race against time. This isn't about what you know anymore. It's all about how fast you can execute. Just look at this timeline. It shows an absolutely mind-blowing compression of time. Decades ago, an arbitrage opportunity could last for years. Take a carry trade, where you'd profit from long-term interest rate differences between two countries. Then that window shrank to months with things like futures contracts. Pretty soon, it was down to seconds for something like index arbitrage. And today? Well, today the biggest battles are fought in the world of high-frequency trading. We are talking about microseconds, 1/1,000,000th of a second. The window of opportunity is now, quite literally, faster than you can blink. It's almost impossible to even comprehend how fast that is. And this brings us to a truly wild concept, latency arbitrage. In this game, the advantage isn't having a smarter idea or better information. It's just pure brute force speed. It's about paying to have your computer physically located closer to the stock exchange's server, just to shave a few microseconds off the time it takes for your data to travel. You're not just trading stocks at this point, you're trading time itself. So we've seen that arbitrage is built on information and speed. But this all raises a much deeper question. What's the point of it all? What role does this ghost in the machine actually play? Is it a helpful force that makes markets better and more efficient? Or is it something else? And here's where we hit the central paradox. See, in a perfect theoretical world, what economists call an efficient market, arbitrage shouldn't even exist. Period. All information would be known by everyone instantly, so no price differences could ever even form. But reality isn't a textbook. Our markets are messy, driven by human emotions like fear and greed, and they're limited by the actual speed of light. And in those persistent little cracks of inefficiency, arbitrage doesn't just survive, it thrives, acting like the market's own self-correcting immune system. The key thing to get here is that the ultimate goal, the absolute holy grail for every arbitrager, is something called risk-free profit. It's the perfect trade. You buy and sell the exact same thing at the exact same instant for two different prices, guaranteeing you make money with zero, and I mean zero, chance of loss. Now, in the real world, this perfect state almost never truly exists, but it's the North Star. It's the ideal that every single one of these strategies is aiming for. But here's the fascinating twist. This relentless hunt for a risk-free world creates the biggest risk of all, something called zero-based thinking risk. This is the profoundly dangerous idea that your model has accounted for absolutely everything, that you've stamped out every possible risk. But markets change, old models fall apart, and the absolute belief that you've achieved perfection can be the very thing that brings the whole system crashing down. So, after all that, where does it leave us? We've seen this incredibly complex, paradoxical force at work. Is arbitrage the engine that powerfully drives our markets toward being fair and efficient, or is it something else entirely? We've really traveled through 3 different layers or planes of this game, haven't we? First, we had the epistemic plane, the world of knowledge, where you turn information gaps into actual value. Then there was the temporal plane, the world of speed, where time itself is squeezed into capital. And finally, the systemic plane, where arbitrage acts as the market's fixer, but in the process, it seems to concentrate more and more power into the hands of those who are already the fastest and the wealthiest. And that brings us to our final fundamental question. Is arbitrage the engine that cleans up the market's messes, making it more stable and fair for all of us in the long run? Or is it the hidden architecture of that same market, a system designed from the ground up to give a massive, almost invisible advantage to a select few? The really uncomfortable answer is, it's probably both. What do you think?